Your dad's financial advisor is still fighting the last war. He's got you in a 60-40 split. Some US stocks, some bonds, maybe a global fund that's actually just 65% American tech names wearing a trench coat, and he calls that diversification. It isn't, not anymore, because the entire logic of buy the world index and chill can be a good strategy, but it was built on one assumption: that the world was becoming one giant frictionless market. Money, goods, chips, oil, cobalt, all of it flowing wherever the price was best, no matter what flag was flying over the factory. That assumption is not always true. We are watching the global economy split into blocks into real time, and almost nobody's portfolio has caught up. Today, I'm going to show you exactly what's breaking, why the index fund religion might not always protect you from it, and how you can actually build a portfolio for a world where geography is destiny again. This isn't doom content. I'm not telling you to buy gold and hide it in a bunker. I'm telling you the map changed and most people are still driving with the old one. Let's get into it. For 30 years now, the story was simple. Berlin Wall falls, China joins the World Trade Organization, container ships get bigger, tariffs get lower, and the capital goes wherever it's treated best. Under that world, diversification mostly meant spreading your money across companies, not across geopolitical systems, because geopolitics barely mattered to your portfolio. A recession in Argentina didn't really touch your Vanguard fund, and who cares about a trade dispute in Asia? That world, it's not really coming back. Trade between the US and China dropped by roughly 30% in 2024 and 2025. That's the two largest economies on earth actively distangling from each other, and the US is redirecting a big chunk of that lost trade towards countries it actually trusts, allies in Europe and Asia. That's not globalization, that's re-globalization along political line. Now, economists have a term for it. It's called friendshoring. You don't trade with whoever's cheapest, you trade with whoever's on your side. And it's not just US and China doing this. The World Trade Organization ran the numbers and found that trade between what they call the Western bloc and the non-aligned bloc has been growing noticeably slower than trade happening inside each bloc. The world isn't collapsing into isolated fortresses. Global trade is still happening, but it's reorganizing itself around alliances instead of pure efficiency. Forecasters expect global trade roughly halve this year compared to last. Here's the part that could scare your portfolio a little bit. It's not really a temporary blip caused by one election or one war. It's kind of structural. Companies are permanently redesigning their supply chains around this new reality, building duplicate factories in safe countries, rerouting shipping lanes, baking sanctions risk directly into their financial planning. When corporations start treating geopolitical alignment as permanent input to where they build factories, that's not a headline, that's the new operating system of the global economy. And there's a second order effect most people miss. Connected countries. Vietnam, Mexico, India, Indonesia, these countries are becoming the middlemen of the new world order. By capturing market share, by sitting between the US bloc and the China bloc, assembling stuff with parts from both sides and selling to both sides. So if you're not thinking about the connected countries, you could be missing a huge chunk where the growth might happen over the next decade. It's not always going to be the superpowers. Sometimes it's the guy running the logistics between them. So your S&P 500 fund could be missing out on a ton of this. Now let's put this on terms you can actually feel. Imagine you spend the last decade building your entire financial worldview around one core belief: that the world only gets more connected, tariffs only trend down over time, and any given company's home country matters less every year. That belief made you money for a long stretch. It was basically free alpha because everyone believed it too. So it was priced into everything and nobody demanded a premium for geopolitical risk. We all assumed everyone just wants to make money, so we're going to the countries that we can make money at. Now flip it. Governments on every side of this fragmentation are actively, deliberately, permanently building redundancy into their supply chains. Not because it's efficient, because efficiency stopped being the top priority. Resilience is the new priority. Resilience is expensive. Building a second factory in a safe country instead of relying on the cheapest one costs money. Stockpiling a bunch of minerals instead of just ordering them, that cost doesn't disappear, it shows up somewhere. Sometimes in higher consumer prices, sometimes in lower margins for companies in the middle, sometimes in outperformance for the companies positioned to benefit from the rebuild. If you don't have a framework for figuring out which side of that equation your money sits on, you're not as diversified as you think. You kind of just distributed randomly across a system to reward one specific bet, and it might start punishing it a bit. I'm going to show you exactly why in the next section, because fragmentation isn't just about which country makes your iPhone, it's about who controls the stuff your iPhone, your EV, your fighter jet literally cannot be built without. Okay, now we're going to focus on rare earths for a second. You've heard of them, you probably don't know why it could scare you. Rare earths are a group of 17 metals that basically go into everything that matters in the next decade of technology. Stuff like EV motors, wind turbines, smartphones, semiconductors, and pretty much the entire US defense arsenal. All of it needs rare earth magnets to function. Here's the twist that could alarm you. Rare earths aren't actually rare. China holds a third of the world's known reserves. The problem is turning dirt into usable materials. the processing. And China controls roughly 90% of rare earth processing capacity and something like 99% of the separation capacity for the heaviest, most defense critical rare earths. That's not a supply chain, that's a chokehold. And Beijing knows it. Through 2025 and into 2026, China rolled out increasingly aggressive export control regimes on rare earths, not just banning exports outright, but requiring individual license for shipments, with Chinese officials given wide discretion to slow walk, deny, or condition approvals. At one point, the rules got so aggressive, they required a license for any foreign product anywhere in the world that contained even a trace amount, like a 0.1% of Chinese sourced rare earth material. That's not trade policy, that's economic sovereignty being asserted over the entire planet's supply chain. There was a partial stand down after a Trump-Xi meeting in late 2025. Tariffs came down, some of the export controls got suspended until November 2026, but here's what the analysts who actually study this closely keep saying. This is a pause, not a reappeal. The licensing infrastructure is still sitting there. It's fully built, ready to be switched back on whenever it's strategically useful. One analyst put it well. China doesn't see the licensing system itself as something up for negotiation. It's a permanent lever. Whatever gets negotiated is how hard they'll pull it. And it's not just rare earths. This is happening across the entire critical minerals map. The Democratic Republic of Congo, which produces most of the world's cobalt, the stuff your EV battery needs, banned cobalt exports outright in early 2025, then swapped the ban for a strict annual quota, which is less than half of what the market was used to getting. Indonesia banned raw nickel ore exports years ago and has only tightened the screws since, forcing companies to build processing plants on Indonesian soil if they want access to Indonesian nickel at all. Vietnam changed its mining laws so only government-approved companies can even touch rare earth extraction, and banned exporting the raw, unprocessed material entirely. This is resource nationalism. It's a defining economic trend of the last decade that almost nobody under 30 is paying attention to. Countries that sit on top of this strategic resources are done being extradition colonies for wealthier nations. They're saying, if you want our lithium, our cobalt, our nickel, our rare earths, you process it here, you employ our people, and you pay our price. The West is scrambling to respond. In February 2026, the US launched something called Project Vault, a multi-billion-dollar strategic reserve of critical minerals plus loans to rebuild domestic processing capacity. They also stood up a 54-nation alliance to try build a parallel supply chain outside of China's control with coordinated price floors so domestic miners don't get undercut into bankruptcy by Chinese overproduction. The EU launched its own version through the Critical Raw Minerals Act. Australia literally ordered Chinese shareholders to divest their stakes into a domestic rare earth mining company because owning even a minority stake was national security risk. Here's the number that should stick with you. Independent analysts estimate it will take 5 to 7 years and tens of billions of dollars just to build meaningful alternative rare earth processing capacity outside of China. Some estimate a full generation, 20 to 30 years to actually replace Chinese dominance. Meanwhile, the window analysts are saying the West has to even start closing that gap is maybe 12 to 18 months before China's structural advantages become basically permanent. And rare earths aren't even the only choke point story. Zoom out and you'll see the exact same pattern playing out with advanced semiconductors, where the overwhelming majority of the world's cutting-edge chip manufacturing sits on one island in one of the most geopolitically contested pieces of real estate on the planet. Different resource, different region, same structural risk. An enormous chunk of global technology depends on one supply chain that runs through a single choke point, sitting directly inside a live geopolitical fault line. That's not really a coincidence. That's what modern globalization actually did. It optimized so hard for efficiency that it quietly built the entire world economy on top of a handful of single point failures. And nobody cared until governments started treating those points of failure as leverage instead of just logistics. There's also a really important distinction buried in here. Most financial media, they're just glossing over it. Now look, tariffs versus export controls. A tariff is a tax, it's reversible with a signature. A president can raise it on Monday and cut it on Friday. Markets have basically learned to shrug off tariff headlines because they know the number can flip overnight. Export controls, especially the kind wrapped in national security law with individualized licensing review, are completely different animal. They create institutions, approval processes with paper trails. Once the government builds that machinery, it doesn't just evaporate when the political mood changes, bro. That's why analysts who track this stuff closely keep warning that what looks like a resolved trade dispute is often a pause button, not an undo button. The infrastructure for control stays built. It gets switched back on whenever it's useful again. That distinction matters enormously for how you should read the news. When you see a headline saying US and China reach trade truce, your instinct might be to relax. Ask whether what got rolled back was a tariff, which is genuinely reversible, or an export control regime, which is a structural feature that has just been temporarily muted, sitting there ready to be reactivated the next time there's leverage to extract. So why does any of this matter to you, a guy trying to build a portfolio? Because this is exactly the thing of just buy the index cannot really price in properly and cannot protect you from. When a single country can flip off a switch and choke off the material inputs for an entire technology sector, EVs, defense, semiconductors, renewables, you know the drill. Geography stops being a footnote in your investment thesis. It becomes the investment thesis. Now, don't get me wrong, you don't gotta switch up your entire portfolio for this, but I feel like even pricing it in a little would do a lot. Let's talk about why traditional diversification doesn't price this in. Old school diversification says spread your money across asset classes and sectors, you're protected because they don't all move together. Stocks zigzag, bonds zag, tech underperforms, energy outperforms. Fine, that logic still works for garden variety recessions and interest rate cycle, but it was never designed to protect you from correlated geopolitical shock. Think about what a typical globally diversified index fund actually holds. It's diversified by company. It's not diversified by supply chain exposure to a single choke point. You could own 50 different companies across 10 different sectors, and every single one of them could be quietly dependent on the same rare earth processing facility in Baotou, China. That's not diversification, that's illusion that there's diversification. Sitting on top of a single failure point that nobody bothered to check. And here's the part that contests the old model. In a fragmenting world, alignment starts to matter more than fundamentals in the short to medium. A well-run company sitting in the wrong block or dependent on the wrong supplier can get hit by a licensing decision made in a government office thousands of miles away, a decision that had nothing to do with how well the company is run, everything to do with which flag it flies under. Meanwhile, a mediocre company inside a protected, subsidized, price floor domestic supply chain, think something like a Western rare earth miner getting a government guaranteed price floor, can outperform purely because of where it's standing, not what it's doing. This is a new dynamic, and it didn't really matter for most of the last 30 years. It matters enormously now. There's also quite a shift happening in how capital moves itself. Researchers tracking foreign direct investment, actual factories being built, not just stock trades, have found that investment flows are increasingly sensitive to political alignment between countries. Companies aren't just chasing the cheapest labor or the best tax rate anymore. They're actively avoiding building critical infrastructure and companies on the wrong side of the geopolitical line, because they've watched what happens when you get caught exposed. That shift shows up in real economic data going back over a decade, and it's been accelerating hard since 2019 now. So here's the truth. Now that just buy VOO and forget about it, that strategy assumes the 20th century trend of increasing global integration just continues forever. I'm not saying like everyone's gonna hate each other and it's all gonna fall apart, but it's been an incredible bet for 30 years, but now it's a bet against a murky geopolitical fault line. I'm not telling you to abandon index investing. Index funds should be the base of almost anyone's portfolio, and anyone telling you to go all in on some concentrated geopolitical thesis with your entire net worth is selling you something. But the base of the portfolio and the whole strategy are two different things. The question isn't, are index funds a yes or a no? The question is, what do you build on top and around that old school diversification? Let me make this concrete with a hypothetical, because abstractions don't really stick. Let's picture two young guys, both 25, doing everything right by conventional advice. Guy A puts every spare dollar into a total world stock index fund and calls it a day. Guy B does the same core index fund, but also spends, like 30 minutes a month actually checking where his exposure sits. He's loaded up on companies dependent on a single foreign choke point. Does he have literally zero exposure to the resource nationalism trade? Is his international allocation actually capturing the connector country shift, or just quietly overweighing the same handful of mega cap countries it always has? 5 years from now, if fragmentation keeps accelerating the way every forecaster currently expects it to be, even if it's not as strong as it's being forecasted, guy A and B might hold nearly identical funds on paper and still end up with meaningfully different outcomes. Not because one of them timed a trade better, because one of them was aware of a risk factor the other one never thought to check. That's the whole pitch of this video. Not abandoning indexing, just stop being blind to a variable that's structurally important. Alright, here's how I actually think about this. 4 pieces. 1, map your block exposure, don't just map your sector exposure. Before you look at whether you're in tech, energy, healthcare, ask a different question. Of my total portfolio, how much sits inside companies whose supply chains, revenue, or manufacturing depend heavily on a single geopolitical bloc staying friendly? Just know your exposure the same way you know your exposure to interest rates or inflation. Most people have literally never asked this question about their portfolio. You should be able to answer it in under a minute. 2, understand the difference between choke point risk and choke point opportunity. Rare earths, cobalt, nickel, semiconductor fabrication is simultaneously a massive risk if you're exposed to downside stream and a massive opportunity if you're exposed to the upside stream. Governments are currently throwing tens of billions of dollars at building parallel supply chains outside Chinese control, domestic processing, allied mining partnerships, strategic reserves, price floors, and it is one of the most heavily subsidized industrial build-outs happening anywhere in the developed world right now. I'm not saying to go pile your rent money into a junior mining stock. I'm just saying understand this sector exists, understand why it exists, and decide deliberately whether you want any exposure to it. 3, pay attention to the connected countries, not just the superpowers. We talked about Vietnam, Mexico, India, Indonesia, countries positioning themselves as the middle ground between blocks. Historically, these markets have been treated as risky emerging markets by conventional portfolio models, but the actual structural trend of this decade is capital and manufacturing rerouting to these connected countries. A token 2% emerging markets allocation buried inside a global index fund might not capture all of that. You don't need to become a Vietnam stock picker. It's just that some international exposure and the right kind of international exposure are not the same thing, and most people's portfolios don't distinguish between them at all. 4, treat geopolitical concentration the same way you treat single stock concentration risk. If someone told you to put 40% of your net worth into one company, you'd call that reckless no matter how much you like the company. Apply the exact same logic to blocks and choke points. If your entire equity portfolio is quietly dependent on stability between 2 specific superpowers, that is concentration risk, even if it's spread across 50 different tickers. The fix isn't panic selling everything and buying gold coins. The fix is the same you apply to any concentration problem. Diversify the thing you're actually concentrated in, which in this case would be geopolitical alignment, not just company or sector. 5, reassess your definition of safe. For decades, safe in a portfolio meant government bonds, blue chip stocks, maybe some gold. That's not wrong, but it's incomplete now. In a fragmenting world, part of what makes an asset genuinely safe is how insulated it is from a geopolitical decision. A blue chip company worth 40% of its revenue and half its supply chain running through a single contested region isn't automatically safe because it's a household name or because it's been around for 8 years. Meanwhile, a boring domestic infrastructure company benefiting from onshoring subsidies might carry less geopolitical fragility than a global brand everyone assumes is bulletproof. Safety used to be mostly about company quality and balance sheet strength. Now it can include a question that nobody really used to ask that much. How exposed is this business to a decision made by a government that isn't ours? None of this requires a Bloomberg terminal or a finance degree. You just need to read where your exposure is. Someone's going to watch this video and go all in on rare earth mining penny stocks tomorrow. Don't. Choke point sectors like critical minerals are exactly the kind of trade that gets front-run, hyped, and dumped on retail by the time it hits your algorithm's recommended feed. Prices of these materials have already spiked in several 100% on licensing news alone. That's not stable, boring compound trade. That's volatile, headline-driven trade. You need to size it like one. Second mistake is don't confuse understanding geopolitical risk with becoming a full-time geopolitics day trader. You're not going to outpredict the next Trump-Xi meeting. The point of this framework isn't to time the next export control announcement. It's to make sure your baseline portfolio isn't accidentally betting everything on a version of globalization that's already dying. And third, this stuff moves fast and changes constantly. Suspensions get extended, tariffs get renegotiated, truces get broken. Anything I've said on specific numbers today will be stale within months. That's not a flaw in the analysis, that's the entire point of this video. This is now a permanent moving variable on how markets work, not a one-time event you can learn once and forget. You don't need to panic, you don't need to abandon index funds. Need to add a layer most people don't even know is missing. Understanding where your money actually sits in this fractured world, not just what ticker symbol it's wearing. Geopolitical alignment, resource control, and supply chain geography aren't really side issues anymore. They're becoming fundamental to how markets move as interest rates have been for the last 40 years. The guys who learned to read that map early are going to have a real edge over the guys who are still investing like it's 2015, chasing the same generic advice their dad's advisor has been recycling before the iPhone has existed. But look, I'm not here to bash on that, but the whole point of this channel is just looking at finance in a lens that most people aren't really thinking about. Thank you if you got all the way to the end. Subscribe for more. I'll see you in the next one.